Global capital is voting with their feet. China's $4 billion bonds spark a frenzy, while US bonds are dumped. What does this mean for your wallet? Dear viewers, global capital has recently been collectively voting with their feet. Can you believe it? China's $4 billion bonds have triggered a mad scramble among global funds. While US bonds once considered safe assets are being sold off one after another. What signals are hidden behind this? Is the US dollar system on the verge of a major shift? And how will this wave of financial changes impact our wallets? Today, we'll dig deep into the new direction of this grand global financial game. First, we must clarify the core signal. China's issuance of $4 billion in bonds this time is by no means an isolated attempt, but the starting point for launching a mass replication model of related strategies. The issuance of sovereign bonds often carries strategic significance beyond financing. This issuance coincides with a period of global US dollar liquidity surplus and growing doubts about US bond credibility, making it essentially a precise market test. The results clearly validate the global recognition of China's creditworthiness and mark a profound transformation in the logic of global capital allocation within the immense of the issuance. Multiplexnest unsenterprisbently's Lionel necessario with individual chindrinxi, alakokivigo variants. Somiva natractown 300 billion in bids. For example, the 2 billion superfishing shisnaninin, Saudi Arabia, with the Spispofendration, included 3-year and 5-year tenors. The total subscription function 39.73 billion. 19.9 times the issuance size, and the 5-year tranche saw a subscription multiple as high as 27.1 times, setting a record for global sovereign bond issuances in recent years. This means global capital has formed a consensus that Chinese US dollar bonds are equivalent to safe assets. There is no need for the government to test the waters personally. Corporate bond issuances alone can divert a large amount of capital that would have otherwise flowed into US bonds. From a market data perspective, while the issuance scale of Chinese corporate US dollar bonds has fluctuated, the oversubscription trend has remained stable. Even amid heightened global financial market volatility and rising financing costs for emerging markets in 2024, so US dollar bonds maintained strong appeal. The core reason lies in the robust debt servicing capacity of Chinese enterprises, especially SOEs, which has become a key bargaining chip to attract global capital. Statistics show that in 2024, the total scale of overseas US dollar bonds issued by Chinese SOEs exceeded $30 billion, with an average subscription multiple of over 8 times, far higher than the average for emerging market enterprises. In-depth analysis reveals that Chinese US dollar bonds can divert capital from US bonds primarily due to 3 key advantages that US bonds lack. 1. Solid debt servicing guarantees. By the end of 2024, China's foreign exchange reserves stood at 3.12 trillion, with an annual trade surplus 809.6 billion, providing a strong backstop for debt repayment. 2. Stable yield expectations. Coupon rates are generally higher than those of US bonds of the same tenor, while credit risk is lower. 3. Clear growth prospects. China's sustained and stable economic growth provides a favorable environment for the operations of bond issuers. In terms of investor structure, in addition to European and American hedge funds and pension funds, sovereign wealth funds from emerging markets such as the Middle East and Southeast Asia have also actively participated. This not only confirms the global appeal of Chinese US dollar bonds but also reflects the declining trust in US dollar assets among global capital. This mass replication effect is triggering a series of chain reactions. For Chinese enterprises, it has opened up broader overseas financing channels, reduced reliance on the domestic financial market, and promoted financial market internationalization. For global capital, it has provided a new safe asset option, breaking the monopoly of US bonds in the safe asset sector. Notably, Chinese enterprises have always adhered to market-oriented principles in bond issuances, flexibly adjusting scale, tenor, and interest rates based on market demand. They have designed various tenors ranging from 2 to 30 years to meet the allocation needs of different investors. Additionally, leveraging its geographical advantages, sound financial infrastructure, and rich experience. Hong Kong. China has become the primary venue for Chinese enterprises to issue bonds. In 2024, US dollar bonds issued by Chinese enterprises in Hong Kong accounted for over 75% of the total overseas issuance, making it the world's largest center for Chinese US dollar bond issuances. The mainland plus Hong Kong linkage model has not only promoted financial opening up but also provided convenient investment channels for global capital. In summary, the strategic significance of China's $4 billion bond issuance far exceeds financing itself. It has driven a transformation in global capital allocation logic, making Chinese US dollar bonds a safe haven for global capital, injecting vitality into the diversification of the global financial system. This effect will continue to amplify, further reshaping the global financial landscape. Even more noteworthy is the strategically significant small clause embedded in US dollar bonds issued by Chinese SOEs, allowing bondholders to choose RMB repayment upon maturity. This clause breaks the traditional convention of US dollar-only repayment for US dollar bonds, providing investors with a new option to hedge exchange rate risks, and marking a key step in the reform of the global monetary system. In traditional US bond investments, investors can only receive principal and interest settled in US dollars, bearing the full risk of US dollar exchange rate fluctuations. In contrast, with Chinese US dollar bonds, even if the US dollar depreciates sharply in the future, investors can proactively choose RMB settlement, backed by China's solid manufacturing base and stable foreign trade orders. The RMB's purchasing power is far more stable than the US dollar, which is maintained through money printing. From a market practice perspective, this clause has demonstrated significant appeal. A $1 billion bond issued by a large energy SO, which included the RMB repayment option, achieved a subscription multiple of 12 times, far higher than ordinary US dollar bonds of the same period. From a macro perspective, this clause aligns with the trend of global monetary system diversification. In recent years, the US's reckless issuance of US dollars has led to a decline in global trust in the currency, prompting countries to seek ways to reduce reliance on the US dollar. As the world's second-largest economy and largest goods trading nation, the RMB has become the fifth-largest global payment currency, third-largest trade finance currency, and second-largest cross-border investment and financing currency. This clause has opened up a new path for RMB internationalization. For issuers, this clause also helps reduce financing costs and exchange rate risks. Most main businesses of Chinese SOEs are domestic, with revenues primarily in RMB. Traditional US dollar bonds expose them to exchange rate risks. The introduction of the RMB repayment option allows them to flexibly choose the repayment currency based on cash flow and exchange rate trends, effectively hedging risks. At the same time, the clause enhances bond appeal, enabling enterprises to secure lower coupon rates. From a global capital allocation perspective, amid declining yields and rising risks of US dollar assets, RMB assets that can hedge exchange rate risks have become increasingly popular. Chinese US dollar bonds, with their robust creditworthiness, stable yields, and unique repayment clauses, have emerged as key allocation targets. By the end of 2024, over 2,000 global investors held Chinese US dollar bonds, including sovereign wealth funds and pension funds, long-term institutional investors that enhance market stability and drive global capital allocation toward RMB assets. Furthermore, this clause provides a model for innovation in the global bond market, with some emerging market countries beginning to experiment with local currency repayment options in their sovereign bonds, promoting the diversification and marketization of the global bond market. In the future, as RMB internationalization and China's financial market opening deepen, the RMB repayment clause is expected to become a standard feature of overseas bond issuances by Chinese enterprises, contributing more to the stable development of the global financial system. The global capital's preference for Chinese US dollar bonds has trapped the US in a vicious cycle. The more eager it is to solve problems, the more mistakes it makes. This cycle stems from deep-seated contradictions in the US economic structure and changes in the global financial landscape, and the rise of Chinese US dollar bonds has further exacerbated this predicament. For a long time, the US has relied on the US dollar hegemony and the dominance of the US bond market to control global capital flows. Now this power structure is being shaken. Some may question whether the US can suppress Chinese US dollar bonds by pressuring rating agencies. In fact, relevant forces have attempted this but failed, primarily because rating agencies must base their assessments on facts and cannot fully submit to political pressure. Among the three major international rating agencies, Moody's and Fitch have upgraded the credit outlook of relevant Chinese issuers, citing China's US dollar debt servicing capacity far exceeding market expectations. By the end of 2024, China's $3.12 trillion in foreign exchange reserves and $809.6 billion trade surplus mean that even if future bond issuances expand to $40 billion or even $400 billion, the debt servicing pressure will be negligible. In contrast, the US's creditworthiness continues to deteriorate. By the end of 2024, US federal debt exceeded $37.7 trillion, with annual interest payments approaching $1 trillion, relying entirely on issuing new debt to repay old debt. The 2024 federal budget deficit reached $1.7 trillion, accounting for 5.8% of GDP, far exceeding the 3% international warning line, forcing the US to issue more bonds to cover the gap, further pushing up financing costs. In 2024, the yield on 10-year US Treasury bonds once exceeded 5%, a 20-year high. Meanwhile, economic growth remains sluggish and inflation is a persistent problem. Standard & Poor's has downgraded the US sovereign credit outlook from stable to negative. The failure of US pressure on rating agencies also reflects that global investors have developed independent judgment capabilities and no longer rely solely on rating results. In an era of transparent information, investors can access operational and financial data of Chinese enterprises through public channels. The stable operations and strong debt servicing records of Chinese SOEs have been verified through market practice, making them more convincing than ratings. In contrast, the US bond market is facing unprecedented pressure. In 2024, major global holders of US bonds reduced their holdings by a total of approximately $480 billion. And US domestic institutions also cut back on US bond allocations due to rising yields and increased risks, making it more difficult and costly for the US to issue bonds. The US's vicious cycle is also reflected in its policy dilemma. Expansionary fiscal and monetary policies will widen the deficit, increase US debt, or exacerbate inflation and erode US dollar credibility. Contractionary policies may lead to economic recession and rising unemployment. Furthermore, the US's mindset of financial hegemony has led to repeated mistakes in its responses. It is accustomed to using financial tools to suppress competitors. But in today's diversified global financial landscape, this approach is no longer effective. China has always promoted financial opening up in accordance with market-oriented and rule of law principles, and its US dollar bond issuances comply with international rules, gaining recognition from global investors. US attempts to interfere through non-market means not only violate objective laws but also damage its own credibility, prompting more countries to seek to reduce reliance on the US dollar. In summary, the root cause of the US's predicament lies in its own economic structural contradictions and hegemonic mindset. If it fails to face up to its problems and abandon hegemony, the predicament will worsen. The flow of global capital toward high-quality assets such as Chinese US dollar bonds has become an irreversible trend. Many people may further wonder, can the US directly introduce policies to restrict capital flows to China? For example, explicitly prohibiting US financial institutions from purchasing US dollar bonds issued by China. On the surface, this approach seems effective, but in-depth analysis reveals that it is actually a foolish act of cutting off one's own arm. It is important to note that among the core institutions holding US bonds globally, a significant portion are global hedge funds pursuing a balance between returns and safety, with core operational goals of stable profits plus asset security. If the US government forcibly restricts these funds from purchasing Chinese US dollar bonds, what choices will they make? They will obviously not hold depreciating US bonds and bear losses passively. Instead, they will likely sell off US bonds on a large scale and redirect capital to high-quality assets in regions such as Europe and the Middle East. This will only accelerate the US bond sell-off and plunge the US bond market into a deeper crisis. Does the US government make such a decision? The answer is clearly no. After all, the US currently relies on these global institutions to absorb its bond issuances. Once deprived of their support, the US bond market could collapse at any time. A key background piece of information: oil-producing countries in the Middle East such as Saudi Arabia and the United Arab Emirates (UAE) have begun to follow China's lead and imitate its US dollar bond issuance model. This is not only recognition of China's financial model but also an important signal of changes in the global financial landscape. The core motivation is that Middle Eastern countries have realized through China's practice that issuing US dollar bonds can not only attract global capital but also gradually reduce economic and financial reliance on the US. In the past, Middle Eastern countries earned massive US dollars from oil exports but had few high-quality investment options, forcing them to passively purchase US bonds. Their wealth was heavily dependent on the US dollar exchange rate and US bond performance. In 2020, the Federal Reserve's unlimited quantitative easing led to US dollar depreciation, causing significant losses in Middle Eastern countries' US bond assets. Rising US bond credit risks have further prompted them to seek new investment and financing models. China's success with US dollar bonds has provided a model for Middle Eastern countries. In recent years, Saudi Arabia and the UAE have actively adjusted their financial strategies. On the one hand, increasing investment in Chinese US dollar bonds. On the other hand, issuing their own US dollar bonds. In 2024, Bank of China, as the lead underwriter, assisted Saudi Arabia's public investment fund in issuing 3 batches of fixed-rate overseas bonds totaling $5 billion, with tenors of 5, 10, and 30 years and coupons of 5.00%, 5.250%, and 5.375% respectively. The subscription multiple exceeded 8 times, with Asian investors accounting for over 40%. In the same year, Abu Dhabi Developmental Holding Company issued $2 billion in bonds with tenors of 7 and 30 years and coupons of 4.375% and 5.25%, with Bank of China participating in the underwriting. The investor structure of Middle Eastern US dollar bonds is highly consistent with that of China's, attracting a large amount of global capital from Asia and Europe, further diverting funds from US bonds and weakening US financial dominance. Today, Middle Eastern countries can not only purchase Chinese US dollar bonds but also conduct energy trade with China using RMB settlement, opening up a safe channel for US dollar assets. Energy trade is the economic lifeline of Middle Eastern countries, which has traditionally been settled in US dollars, forcing them to hold large amounts of US dollar assets. With the deepening of energy cooperation between China and Gulf countries, the proportion of RMB settlement has been steadily increasing. According to joint data from the People's Bank of China and the General Administration of Customs, the proportion of RMB settlement in China-Saudi Arabia oil trade reached 18% in 2024, a significant increase from less than 5% in 2020. This not only reduces US dollar reliance but also achieves diversified asset allocation, hedging exchange rate fluctuation risks. More importantly, China can provide tangible development support to Middle Eastern countries, such as building factories and improving infrastructure, helping them address the challenges of a single economic structure and over-reliance on energy exports. This is far more reliable than the US's constantly depreciating US bonds. China's Belt and Road Initiative has provided development opportunities for Middle Eastern countries, with extensive cooperation in infrastructure, manufacturing, new energy, and other fields. Projects such as the Red Sea New City and the China-UAE Industrial Capacity Cooperation Demonstration Park have created a large number of jobs in Saudi Arabia and promoted the development of non-energy industries. The issuance of bonds by Middle Eastern countries following China's lead has also triggered a series of chain reactions, promoting the deep integration of global energy and financial markets, forming a new international economic cycle of RMB settlement for energy trade plus US dollar bond issuance. intensifying global capital competition, prompting capital to flow to countries and regions with good credit and broad development prospects. This is not only conducive to the economic transformation of Middle Eastern countries but also helps stabilize the diversified development of the global financial system. It also reflects the rise of China's influence in the global financial field through practice. China has provided emerging market countries with a financial model that balances financing, risk prevention, and long-term sustainable development, which is of great practical significance amid sluggish global economic recovery and volatile financial markets. In the future, as cooperation between China and Gulf countries deepens, the synergistic effect in the financial sector will further emerge, injecting new impetus into the global economy. Many friends may wonder, what does this grand global financial game have to do with ordinary people's daily lives and wealth accumulation? In fact, the connection is extremely close. Changes in the global financial landscape will ultimately be transmitted to ordinary people through various channels, affecting their income, consumption, investment, and wealth accumulation. As global capital flows from U.S. bonds to Chinese U.S. dollar bonds and various RMB assets, two positive changes directly related to people's vital interests will occur. The first change is that the RMB's purchasing power will become more stable. Even if the US dollar depreciates sharply in the future, the cost of importing core livelihood commodities such as oil and grain will not rise significantly, ensuring the stability of basic living costs. This stems from China's solid economic foundation and global capital's recognition of RMB assets. In recent years, amid increased global economic uncertainty and large fluctuations in the US dollar exchange rate, the RMB-US dollar exchange rate has remained at a reasonable and balanced level. In 2024, the fluctuation range was controlled within 3.2%, far lower than the average fluctuation of over 8% for emerging market currencies. International oil and grain are priced in US dollars. When the US dollar depreciates, the stability of the RMB can avoid a sharp rise in import costs. In 2024, international oil prices rose by 15%, but due to the RMB's 2.1% appreciation against the US dollar, China's RMB-denominated import cost for oil only increased by 12.2%, which was directly reflected in the stability of domestic refined oil and grain prices. At the same time, the stable purchasing power of the RMB is conducive to the development of China's foreign trade and manufacturing industry, reducing enterprises' exchange rate risks, enhancing the international competitiveness of products, and driving employment and residents' income growth. In 2024, China's total export volume increased by 7.6% year-on-year. Manufacturing exports grew by 9.8%, and residents' per capita disposable income increased by 4.8% in real terms, higher than the economic growth rate. The second change is that the value of high-quality domestic assets will gradually become prominent. High-quality real estate in core cities and stocks of SOEs with core technologies and stable cash flows will become safe havens for global capital with sustained long-term value growth. Global capital flows are a weather vane for high-quality assets. The influx of capital into RMB assets will push up demand for high-quality assets. In terms of high-quality real estate in core cities, the price of high-end residential properties in prime locations in Beijing rose by 4.2% year-on-year in 2024, while high-quality commercial real estate in core areas of Shanghai increased by 5.1%, far higher than the growth rate of ordinary real estate. In addition to domestic rigid demand, the influx of global capital is an important reason such assets offer stable rental income and long-term appreciation potential, can hedge inflation and exchange rate risks, and are supported by a solid economy and population. In terms of SOE stocks, Chinese SOEs have made breakthroughs in core technologies in fields such as new energy, high-end manufacturing, and information technology, with continuously improving cash flows, making them important targets for global capital to allocate Chinese assets. In 2024, the scale of foreign holdings in listed SOEs increased by 13.8% year-on-year, and their stock prices rose by an average of 10.5%, far outperforming the market average. For ordinary people, the appreciation of high-quality assets is directly related to wealth accumulation. Property owners will see an increase in wealth, and investors can obtain stable dividends and capital appreciation through high-quality SO stocks. At the same time, the appreciation of high-quality assets has boosted residents' property income. In 2024, China's residents' per capita property income increased by 9.2% year-on-year, accounting for 11.5% of per capita disposable income, an increase of 0.8 percentage points from the previous year. Furthermore, the influx of global capital will promote the improvement of China's domestic financial market, increasing liquidity, enhancing pricing efficiency, and promoting financial product innovation. It will also urge enterprises to improve corporate governance and operational capabilities, ultimately benefiting ordinary people. It is important to emphasize that the flow of global capital toward RMB assets is a long-term trend. Ordinary people should recognize this trend, allocate assets rationally, avoid the risk of asset depreciation caused by US dollar depreciation, seize the opportunity of high-quality asset appreciation, and at the same time view fluctuations rationally and choose investment targets that match their risk tolerance. Of course, we must maintain a clear understanding. The collapse of the US dollar status as the dominant global currency will not happen overnight. It will not be an overnight process. The US still holds what is considered its trump card, the Federal Reserve's monetary issuance power, commonly known as the money printing machine. However, it is important to clarify that the power of this trump card is now increasingly weakened. Looking back at 2020, the Federal Reserve successfully suppressed US bond interest rates to near zero by printing 2 trillion. But in the current market environment, even if the Federal Reserve expands its money printing to 5 trillion, it will likely not achieve the same effect. Why has this changed? The core reason is that global capital has completely seen through the essence of the US dollar. They clearly understand that the US dollars printed by the Federal Reserve are watered-down money, lacking physical support, which faces the risk of continuous depreciation once held. Instead of holding such US dollar assets, it is better to take the initiative to purchase more value-stable assets such as Chinese US dollar bonds and RMB assets. This is like a pool filled with water. On one side, the Federal Reserve continues to open the sluice to inject water. On the other side, there is an expanding outlet draining water continuously. In this situation, no matter how much water is injected, the water level in the pool will be difficult to rise, and US bond interest rates will naturally not be suppressed successfully. In addition to the aforementioned obvious changes, a more subtle and far-reaching transformation is taking place. Through the combination of issuing US dollar bonds plus promoting RMB settlement for energy trade, China is gradually restructuring the global trade payment and settlement system. This system is the core infrastructure of the global economy, long dominated by the US dollar, forming an important pillar of US dollar hegemony. China's combined strategy is breaking this single dominant pattern, promoting its diversification, which will reshape the operational logic of the global economy and impact the global political and economic landscape. In the past, over 80% of global trade settlements were conducted in US dollars. Today, this pattern is being gradually broken, with more and more countries choosing RMB for settling trade in core commodities such as energy and minerals. The core reason is that the US has frequently used US dollar hegemony to impose financial sanctions and freeze other countries' US dollar assets, undermining the fairness and security of global trade. This has prompted countries to seek to reduce reliance on the US dollar, with RMB settlement emerging as an important option. A typical example is Brazil, which directly receives RMB for iron ore exports to China, then uses the RMB to purchase Chinese industrial products or exchange it to buy Chinese US dollar bonds for value preservation. In this cycle, the US dollar is excluded, and the US's path of harvesting wealth through money printing is rendered ineffective. According to joint data from the central banks of China and Brazil, the proportion of RMB settlement in China-Brazil iron ore trade reached 32% in 2024, a significant increase from less than 10% in 2020. Additionally, due to Western sanctions, Russia has accelerated de-dollarization by 2024. the proportion of RMB settlement in China-Russia energy trade reached 92%. Iran's proportion of RMB settlement in energy trade with China also reached 75%. The participation of these countries has further expanded the RMB's share in global energy trade settlements. In terms of overall scale, RMB cross-border trade settlement has grown rapidly in recent years. In 2024, the scale reached 42.5 trillion yuan, a year-on-year increase of 18.3%, accounting for 7.2% of global trade settlements, nearly doubling from 4% in 2020. Although there is still a gap with the US dollar, the growth momentum is strong and the development potential is huge. China's issuance of US dollar bonds and promotion of RMB settlement have formed a close synergistic effect. On the one hand, RMB settlement for energy trade has enabled relevant countries to hold large amounts of RMB, which can be used to purchase Chinese US dollar bonds, forming an asset allocation cycle of RMB US dollar bonds. On the other hand, Chinese US dollar bonds have attracted global capital, enhancing international recognition of the RMB and further promoting the development of RMB settlement for energy trade. For example, after earning RMB from oil exports, Saudi Arabia's holdings of Chinese US dollar bonds reached $42 billion in 2024, a 2.5-fold increase from 2020. China's promotion of the restructuring of the global settlement system is not only conducive to enhancing its own financial discourse power but also to global economic stability. The US dollar-dominated system has inherent instability. US monetary policy is prone to generating global spillover effects and triggering financial volatility. A diversified system can reduce the risks of single currency dominance, enhance the global economy's resilience to risks, promote fair trade development, and reduce the impact of financial sanctions. From the perspective of global economic governance, this is an improvement and supplement to the existing system. China adheres to multilateralism and win-win cooperation, and RMB internationalization follows market-oriented and rule-of-law principles, respecting the independent choices of various countries, thus gaining widespread recognition. By the end of 2024, the total amount of currency swap agreements signed by China with various countries reached 4.2 trillion yuan, covering major economies and emerging market countries, providing liquidity support for RMB settlement. In the future, as China's economy develops stably, its financial market opens up and improves, and international cooperation deepens, the RMB's role in global settlements will become more prominent. The global trade payment and settlement system will form a diversified pattern with the US dollar, RMB, euro, and other currencies coexisting more fair, stable, and sustainable, injecting new impetus into the global economy. China's combined strategy will also play a more important role in global economic governance. At this point, some friends may further ask, faced with such changes in the financial landscape,
will the U.S. abandon financial means and instead use military force to pressure China? Based on the current global situation and the U.S.'s own strength layout, this possibility is highly unlikely. Although the U.S.'s military expenditure remains large, in-depth analysis reveals that most of its military budget is used to maintain its global military presence, leaving no sufficient military forces to be deployed specifically against China. More importantly, China is currently the largest trading partner of over 120 countries and regions worldwide. Once the U.S. completely falls out with China, the normal trade of these countries and regions will be paralyzed, and the global supply chain will be disrupted. The U.S. itself will also face severe problems such as material shortages and soaring prices. Owing to these practical constraints, the United States can only repeatedly hype the threat narrative in the realm of public opinion and exert verbal pressure, yet dare not adopt any substantive countermeasures in practice. In conclusion, the core significance of China's $4 billion bond issuance experiment is not merely to raise funds, but to provide global capital with a safe escape
route from the existing US dollar system. Today, the feasibility of this route has been fully verified by the market, and more global capital and sovereign countries are choosing this path. The US's core dilemma is no longer whether to save the US bond market, but the reality that even if it wants to save, it cannot. For ordinary people, the core strategy to cope with changes in the global financial landscape is not to panic blindly, but to understand the trend, allocate assets scientifically, avoid the risk of asset depreciation caused by US dollar depreciation, and seize the opportunity of high-quality asset appreciation. In the next episode, we will focus on practical operations and delve into detailed discussions. How can ordinary people keep up with the current global financial trends and scientifically adjust their asset allocation plans? For example, how should idle savings be properly allocated to achieve preservation and appreciation? Which high-quality assets with long-term investment value should be focused on? In addition, many friends have frequently asked whether assets such as gold and Bitcoin are worth investing in under the current financial trends. These questions are directly related to your wealth security in the next 3 to 5 years, and each is worthy of in-depth discussion. As always, let's follow our old rule. If you find today's content helpful and valuable, please like and save it to avoid losing it when you want to review and learn later. If you have any questions or different views and insights, please leave a comment in the comment section. Let's discuss rationally and make progress together. Remember to subscribe to my channel. At the same time next week, I will continue to help you understand how ordinary people can cope with this global financial landscape transformation. See you then, bye.